Most traders look at charts, but only a few can actually read them well. Because inside every candle, every tiny bar you see, there's a hidden story of fear and greed. And once you learn to read that story, you'll start seeing what most traders completely miss. In this video, I'm going to show you how to actually read candlestick charts, not just candle color and size, but what they reveal about market psychology, momentum, and who's winning the battle between buyers and sellers. First of all, what is a candlestick? A candlestick is one of the simplest ways to visualize what happened to a stock or coin's price during a specific period, whether that's 1 minute, 1 hour, 1 day, or any time frame you choose to analyze. In every market, there are two main participants, buyers and sellers. When buyers are in control, the candle opens at a certain price, and as buyers step in, they keep pushing the price higher throughout the session. By the time the period ends, the candle closes at a higher level than where it started, forming a green or bullish candle that represents price appreciation. Conversely, when sellers are in control, the candle opens at a certain price, but instead of moving up, selling pressure pushes the price lower as time goes on. By the time the period ends, the candle closes at a lower level than where it started, forming a red or bearish candle that shows price depreciation during that session. Now that you understand how candles form, let's break down their structure, the body and the wicks, and what each part can tell us about market behavior. Every candlestick is made up of two main parts, the body and the wicks. The body is the thick part in the middle. It shows the range between the opening and closing prices. Now to recap what we've discussed before, the position of the open and close changes depending on the candle color. For a green candlestick, the opening price is at the bottom and the closing price is above, showing that buyers push price higher during that period. For a red candlestick, the opening price is at the top and the closing price is below, showing that sellers drove the price down. Then we have the wicks, the thin lines above and below the body. They represent how far price moved beyond the open and close during that period. The upper wick shows how high buyers managed to push the price before sellers pushed it back down. The lower wick shows how low sellers managed to drive the price before buyers stepped in to push it back up. Now let's bring that story to life by looking at a real chart together. The platform I'm using here is called TradingView. It's one of the most popular charting tools out there and works for both crypto and stocks. If you want to follow along or practice on your own, this is a great place to start. On the top left of TradingView, you can select the coin or stock you want to analyze and the time frame of your candles. Right now I'm looking at Bitcoin on the monthly time frame. For beginners, I'd recommend starting with the higher time frames like the daily, weekly, or monthly because they give you a clear overall picture of where price is heading without all the short-term noise. You can also customize your candle colors to match your own style. In my setup, I'm using green for bullish and orange for bearish candles. You can stick with the classic red and green too. The key is to stay consistent so you don't confuse which direction the candle represents. And the most important thing, the price, which is located on the right side. Now let's take a look at Bitcoin on the weekly time frame in December 2022. Our first example here is the last big bearish candle before the market reversed from bearish to bullish. We can see that the price opened higher at 20.9k. The small upper wick shows that price briefly moved up before sellers took control, driving it down sharply and forming that long lower wick before buyers stepped in and pushed it back up to close around 16.2k. Afterwards, notice how the price just moved sideways. The market formed small-bodied candles, indicating indecision and weak momentum. At this point, buyers are still hesitant to step in, but sellers can't seem to push the price any lower either. And that's where our second example comes in. As you can see, this is a small-bodied bullish candle, meaning the price opened lower, then dropped to around 15.5k before buyers stepped in, pushing it back up to close near 16.4k, just slightly higher than it opened. What makes this candle interesting is the long lower wick. While sellers initially tried to continue the downtrend, they failed as more buyers entered, hinting at a possible reversal or accumulation phase. And sure enough, just a few weekly candles later, more buyers entered, forming these large-bodied bullish candles, signaling that momentum is shifting back in favor of the buyers. Notice how there's barely any wick to the downside. That means buyers were in full control, opening around 17.1k and closing near 20.8k. So as you can see, these candles don't just tell us what the price did, they show us how the market reacted at different price levels as well. If you're enjoying the video so far, don't forget to hit that subscribe button. It really helps the channel grow and keeps you updated with the next episodes. Now that we've seen how buyers slowly regain control, let's talk about another key element of reading candles: the size of the candle body. Big body candles usually signal strong momentum. One side, either buyers or sellers, clearly dominated and drove the price aggressively in one direction. These often appear during breakouts or strong trending moves. Small body candles show indecision. Buyers and sellers were battling for control, but neither managed to move the price much. This often signals a pause in momentum or potential reversal ahead. And finally, we have doji candles. Candles with almost no body at all, meaning the open and close are nearly the same. A doji reflects complete indecision, where both sides pushed hard but ended up right back where they started. So when you are analyzing a chart, don't just look at the colors of the candles, pay attention to their size and context. Big candles confirm momentum, small ones warn you that momentum might be fading. Now that we understand how individual candles reveal momentum and sentiments, let's zoom out and look at the bigger picture, the overall market structure. So how do we identify the characteristics of a bearish market? As we can see in the charts from December 2021 to December 2022, the price of Bitcoin kept forming lower highs and lower lows, showing a clear pattern of downward momentum. But eventually that pattern starts to shift. The three candles we looked at earlier mark the pivot points where the market transitions from bearish to bullish as the price begins forming higher lows and higher highs from that point onward. Another great example is the price action of Solana. From November 2021, its price collapsed, forming a clear series of lower highs and lower lows, classic signs of a bearish market. But as the bear market came to an end, buyers started stepping back in. And as you can see, the structure began to shift. Price started forming higher lows and higher highs, marking the start of a new bullish trend. So remember, whether you're looking at crypto or stocks, the story is always in the candles. By learning to recognize candle size, momentum, and market structure, you'll start to see what most traders miss: the early signs of when a market is about to shift direction. If you found this video helpful, don't forget to like, subscribe, and turn on the notification bell so you don't miss the next episode, where we'll dive deeper into different candlestick patterns.